Greetings, everyone. It is Employment Friday once again. Happy to be with you, and I really want to thank my team for helping pull these charts together for you today. Will Scher, Dan Rodriguez, and Dan White. Couldn't do this without them. So it is Employment Friday, and this employment report is causing some consternation. So as usual, and with the slides, I'll go through fiscal policy, monetary policy, economic indicators, and market indicators, and a little bit on innovation interspersed throughout. But I'll start by summarizing that, this employment report is jarring investors. Because it was much weaker than expected, mostly because of downward revisions to previous months, significant downward revisions. And so fears of recession are starting to surface. And I just want to remind everyone that we have been using this phrase rolling recession for the last 3 years. And I think as we get into the chart, you'll see what I mean. Anticipating that we would get this last leg, especially with the uncertainties around trade and tariffs, tax policy, and regulation or deregulation when it would take place. A lot of those are clearing up right now, and one of the big variables that many people are wondering about now is interest rates. This week, Chairman Powell sounded very hawkish. I think he didn't appreciate being featured along with President Trump at a construction site. So there may have been something else going on there, because the data as it is evolving here is certainly moving in a direction that would lead the Fed to ease. And of course, for the first time since 1993, there were 2 dissents on the Fed board this time around. And that suggests that we probably are going to see interest rate cuts in the future. I think the odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. We think that will resolve positively as well. That's the one uncertainty. And the reason this matters is if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases. So getting back to some kind of equilibrium is going to be important. And that is, we think, the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up, with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. We do know that there's some rumblings today, not rumblings, I guess. President Trump on Truth Social said he was moving 2 nuclear submarines toward Russia because of some provocative statements, it seems, or that he and Medvedev, who's Putin's deputy, have been having words. So there's that going on. So geopolitical risk, we don't think that goes away. And we don't know what's going to happen with Russia and Ukraine. It's unbelievable that it's lasted 4 years so far. The other uncertainties are China and Mexico. Most trade tariffs have been decided as of today, but China and Mexico have, I think, roughly 90 days, 90-day reprieve, so that's an uncertainty. But as I said, the biggest one is the Fed going to move? We think it will move now, even though Chairman Powell sounded quite hawkish this week in his testimony. So with that, let me go through some of these charts and visit first. So we will start with fiscal policy. Now, what's very interesting is year to date, the deficit as a percent of GDP has shrunk from roughly 7.3% to 6.2%. And as we add up all of the tariffs now, they're annualizing, it looks like, at $450 billion per year. So that would take us to the X you see here. I think that's roughly a 4.7% deficit. So we know that's going to happen. And the green line is 3%, which is Treasury Secretary Dissent's objective for 2028, the end of President Trump's term. Well, the 4.7% assumes no growth, and we do think growth will be slow until some of the uncertainties I mentioned are out of the way, but will pick up momentum, and we would not be surprised by the end of 26 to see this metric, deficit as a percent of GDP, at 3%, so 2 years ahead of schedule. So the bond market should appreciate that. And I do think investors, it will be a positive backdrop for equity investors as well. Here you see something interesting about R&D CapEx. You can see in the 60s on the right-hand side that the government dominated R&D CapEx spending as a percent of total R&D spending, 65, so roughly 2/3. And it has dropped consistently over the years, ceding that role to the private sector, which you can see on the left-hand side. So that's gone from roughly 1/3 to more than 75%. We think this is good, and it also highlights something very important from a venture capital point of view. The government, because of this phenomenon, really did launch Silicon Valley as it handed technologies to companies to develop in the 60s and 70s. And what you see today is the opposite, especially when it comes to space and defense. It is the private sector that is leading the government. And we actually think that is very healthy. And it is going to lead to a lot more productivity growth much sooner than otherwise would be the case. Now, I want to point out something in the tax package, the one big beautiful bill package. Some of these are pretty startling changes. In other words, they've never happened before. For example, structures, being able to expense structures in year one has never happened before. And it is now in place as President Trump and team are trying to attract more manufacturing back to the United States. It will be a little bit different from the manufacturing that left the United States, and with it, jobs is going to be much more highly automated, but it will be here in the United States. But you can see these other three categories as well. Equipment, we have seen in the Reagan Revolution, we had this kind of expensing on equipment, but not on the other two categories that you see here, and certainly not permanent. And that's what we think is so interesting. Roughly, I would say 75% of these tax changes, or 75% of capital spending, is going to enjoy permanent expensing. And that has never happened before. So this administration does mean business in terms of attracting manufacturing back to the United States. And we think this is going to be a very good thing. And we think the productivity associated with it is going to be astonishing, thanks to all of the automation and AI that is exploding on the scene today, now that the costs associated with both of them are dropping so quickly. So it's happening at a very good time. And so I've presented this chart before. The federal corporate income tax, while the explicit tax remains at 21%, incorporating the expensing that I just described will take the tax rate, the U.S. corporate tax rate, down to the 12 to 14% range. And the 12.5% range is significant because in the day, the Celtic Tiger, Ireland, began to attract a tremendous amount of manufacturing activity with its 12.5% tax rate. And now we are down at that level effectively. So now we'll go into monetary policy. As I mentioned, Chairman Powell sounded quite hawkish, even though reporters were saying, well, wait a minute, housing seems to be relapsing. And he deflected that. And, well, wait a minute, the metrics you look at in terms of core growth and core inflation, they're all moving in the right direction when it comes to inflation, and actually in the wrong direction when it comes to GDP growth. I think I'm not going to get the metric exactly right, but what Chairman Powell focuses on is real private domestic final sales, and that is running in the 1% range. And we saw that with the consumption figures, very slow. The consumer is becoming quite cautious and beginning to lift the savings rate. We think that could cross 5% this year. But you see, money growth did start turning around. It was negative for quite a while. We're now up to roughly 5%. But when you get cautious consumers, that means the velocity of money, the rate at which it turns over, slows down. So the stimulative effect just isn't going to be there the way that this chart might suggest. We also know that the CPI, which is depicted in the green here, faces some tough comparisons. So I think we have two more tough comparisons at the 0 and 0.1% rate for the next couple of months. So the inflation rate could stabilize here, and maybe that's what Powell was responding to, just knowing that the optics aren't going to look great on inflation, meaning continued progress. But if we're right, that will be it. Then we're off to another leg down in inflation towards the 2% and actually below the 2% range if we are right. Now, of course, we have been expecting much lower inflation for quite some time. Tariffs are complicating the situation perhaps a bit right now. But there are metrics out there. Oh, well, before I go on to inflation, let me just depict Fed policy here. This is the 2-year Treasury yield less the 3-month Treasury yield. And when it is below zero, which it is here and has been for quite some time, monetary policy is restrictive. You can see every time this has happened before, we end up in a recession. And, we're very lucky we haven't ended up in a full-blown recession. It's been more of the rolling variety. But we do think, because of how long this has taken place, the Fed jacked rates up in 22, so it's been 3 years, that a lot of rubber bands are stretching, particularly in the housing and capital spending markets. The housing needs lower rates and or lower prices, and we are starting to see lower prices moving affordability up slightly. I think lower interest rates will really get it going in the next 6 months. And capital spending, now we have certainty with this tax package. And I think those two sectors are very high multiplier sectors. In other words, $1 spent on housing causes all other kinds of spending to take place. When you move into a new home, you're buying lots of stuff. And the same with capital spending, lots of follow on from $1 spent on capital expenditures. So we do think the Fed's too tight. This chart is reinforcing it. We're starting to see a little progress. We've seen a relapse, and we do think it might mean that in September we'll see a 50 basis point cut, and perhaps for the rest of the year, 75 basis points when all is said and done, especially now that employment is showing such weakness. This is the yield curve, but this time using the 10-year Treasury yield minus the 2-year Treasury yield. And you can see when this moves from negative into positive, typically we are in a recession. And I've mentioned this many times. What strikes me is that this yield curve has been flattening in a trend sense since the global financial crisis in 08 and 09. And I think it's beginning to surface the deflationary undercurrents that are taking place out there because of technology. And that will be very good for long rates relative to short rates, longer-term deflationary undercurrents versus shorter-term rates responding to strong unit growth. So it'll be very interesting to see how this unfolds during the next few months. On this chart, you can see trueflation, so back to the inflation discussion, and how it had stabilized. Trueflation measures thousands of items in real time and tends to lead the CPI by 60 days. And so far, so good. The tariffs, they've maybe taken this index up or this inflation rate up a little bit, but we are seeing a lot of tariffs absorbed in margins here in the U.S., so corporate margins. Corporations are eating some of the hit. They are viewing these tariffs as a tax increase on the consumer, and the consumer is quite weak. And a lot of companies have seen negative unit growth, and they don't want to exacerbate that. The other way that these tariffs might be absorbed is by depreciating currencies in China and elsewhere. And that is now starting to happen again. For a long time, this notion that the U.S. was no longer exceptional was driving the dollar down. We think the return on invested capital in the United States relative to that in the rest of the world is going to increase. And a reason for that is the corporate tax cuts that I described earlier. And so we believe this measure of inflation won't go much above 2% and then will resolve to the downside. Again, very good for both fixed income and equity markets. This chart depicts economic policy uncertainty. And you can see here that the uncertainty, especially during tariff turmoil, reached unprecedented levels, even so much higher, which was a surprise to me, than 08-09. I was kind of shocked by that, and higher than COVID. Now, it has improved, and the stock market and other markets are beginning to adjust to the drama around tariffs. But you can see very recently, as depicted by the X, this is a 1-week moving average, the line is. The X is just the latest. There's been a little bit of a backup, as I mentioned before, as we come to the end of tariff turmoil and perhaps have to deal with some saber rattling on the geopolitical front and some concerns on the Fed front. We think many of those will resolve in the months ahead. On this slide, just to give you a sense of where GDP growth and productivity growth are now, this is on a year-over-year basis. They tend to be highly correlated. But you can see the real surges in productivity as measured by as depicted in the green line here. They tend to occur at the beginning of recoveries after recessions. Well, we've been in a rolling recession, and the fact that productivity has held up this well for this long is really saying something about underlying a secular change in productivity growth, and we think it's going a lot higher. We wouldn't be surprised to see 5% or more sustained for much longer than just at the beginning of the rolling recession and expansion. We think the new technologies evolving today, and we talk about them all the time, robotics, energy storage, AI, blockchain technology, and multi-omic sequencing in the life science space, are going to drive huge productivity gains. And we're looking forward to watching where those productivity gains land. Are they going to land in corporate margins? Are they going to land in compensation? Are they going to land in more spending on R&D? Or are they going to land in lower prices? And we think all of those are true. In some regions, some more true than others. For example, in China, given that they're trying to stimulate a consumer economy, they'll probably end up more in worker compensation than perhaps in the United States. In the United States, as the Fed tries to get inflation down, maybe lower prices. But we think all will see some impact. On the next page, you can see, just to illustrate a little bit of drama recently, it's somewhat hard to see, but in the green line there, you see a surge to a level that you've never seen before, just as you saw a drop to a level you'd never seen before. That is the trade impact, the impact of tariffs. The front loading drove the trade deficit up in the first quarter and took real GDP down by 0.5%. This last quarter, second quarter, the numbers just came out, that reversed. And trade actually added nearly 5 percentage points to real GDP growth, which is really saying something because real GDP growth was only 3%. A big part of the offset, or the difference there, was in inventories. Inventories made up a lot of that difference. But it is quite striking that we've had such a shock to the system. And the stock market is where it is, despite today's sell-off. And quite frankly, I'm never happy to see the market going down, but I am happy not to see the market just going straight up. We've had some very big IPOs that seemed frothy, shall we say. Circle was a big one of those, and as you know, ARK was a big beneficiary. Figma was this week's version of that. We think the market, we'd much prefer to see the market climbing a wall of worry, which it has been doing around tariffs. That is a stronger, more durable bull market, and it broadens out. Very recently, there's been a little bit of narrowing, but we think if we're right on what's going to happen to the economy and inflation, that it will broaden out, as it has been benefiting innovation strategies like ours. Here is the drama we got today. The revisions to non-farm payrolls, they were extreme. We typically don't see this kind of revision except in a recession. We're in a rolling recession. I think this confirms it. I think many economists might take these numbers and start running with a longer recession scenario, where we do not believe that. And we do think the equity market will see through that after this wall of worry moved down today and maybe somewhat into next week. Looking through the report, many sectors were down. I think we're seeing the hit to federal government employees. Year to date, those are down now by 84,000. And I think we're facing another 150,000 by the end of September. So that means that 10% of government and federal government employees will have been laid off by the end of September. And of course, a lot of other jobs are tied to the government sector. So I think that's creating some uncertainty in the employee's mind in terms of jobs being there or ending. So you can see this on the next page. Oh, and I'll just add one more point here. Shockingly, the birth-death ratio. Now, this is the assumption about how many jobs have been created by new businesses, so startups, in a given month, minus those lost because of failed businesses. That number was 257,000. It's been averaging 100. So it was, I think the total non-farm payroll increase was 74,000. 257,000 of that was birth-death. And so that would have suggested an extremely negative employment month if that number is not correct, and it's probably not correct. You can see in the confidence index how the consumer is feeling about job growth. This is the labor differential. Jobs easy to get, and again, this is a survey, jobs easy to get minus jobs hard to get. And you can see that at the peak of demand for employees post-COVID, we were close to 50, and now we're down to 10 on this metric. And you can see when we have moved down by this much, typically we have been in a recession. So yet another employment indicator suggesting not as all is not well out there. And you know, I'm sure that the two dissenters on the Fed were pulling up these statistics for Chairman Powell to acknowledge or observe. We got PMI today, very weak. You can see here, this is manufacturing and non-manufacturing. Anything below 50 suggests contraction. in the manufacturing sector. You've seen that has been the case since really 22 here in the U.S., and services now are capitulating as well, as you can see there. On the services side, this is a picture that we're monitoring. We think it's very important. You can see that orders have fallen off as prices have increased in the services sector. And we do think, as orders continue to diminish, that pricing is going to come down quite substantially. For the same reason, it is happening in the goods sector now. Here you can see real PCE ex healthcare. And this is, again, something that Chairman Powell is paying attention to. You can see that this rolling recession, if you exclude healthcare from real PCE, you'll see it's been kind of steady state. But now that employment is in question, this could come down dramatically. You can see during recessions how much it does come down. And so I think we might get some very weak statistics, which will seal the deal for lower interest rates in the next few months. Here are auto sales. They're already on their way down after some pre-buying ahead of tariffs. They are unwinding, and all auto manufacturers, including Tesla, are experiencing some pain here. It's interesting. Today I saw Tesla's sales, I think in July in Spain, were up 27%. Well, that's very interesting because Elon Musk has decided that he should head up sales for North America and Europe now that a really long-term head of sales has departed. So he obviously thought some changes needed to be made, and maybe they're working already. Who knows? Here, just again, illustrating to bring trade back into the fold here, the drama that we saw around tariffs and around GDP growth. Also, the drama in housing, a relapse. The spring selling season was a bust. New and existing home sales have relapsed. Affordability has not improved, but it is going to improve, we think, because this chart suggests new one-family houses for sale are reaching near all-time highs, like those we saw before the global financial crisis, when there was a huge overbuilding in housing before the 08-09 crisis. There's been some building, but this basically is saying builders can't get rid of the houses they've built. They're going to have to give concessions. They've been buying down mortgages, trying to get those rates lower for buyers, but this chart suggests they will have to continue cutting prices. And as you can see here, the new home prices have been falling gradually, not dramatically, for 2 to 3 years. Existing home prices, and this is a 3-month moving average, year over year, are up only 1.7%. Now, the important read-through here is these numbers, these prices, get into the CPI with a long lag. And so the CPI is now going to be weighed down by one of the largest contributors to the CPI. All told, shelter accounts for 40% of the CPI. And this metric says that that shelter part of the CPI is going to move into sub 2% territory later this year. Again, sealing the deal for lower inflation and interest rates. And then to address the dollar, I know the headlines were blaring, worst dollar start to the year, our worst first half since I think 1993, if I'm not mistaken, which, by the way, was the last time 2 Fed directors had dissented from the policy being made. So you can see that all of that drama put in context was a little exaggerated, shall we say. And if you look at the next chart, I did present it for the first time last month, you can see here that the uptrend has not been broken. And if we're right on return on invested capital, it will resume its increase relative to the 26 countries in this index. Inflation, as measured by commodities, it is kind of shocking still that tariffs notwithstanding, it's today where it was in the early 90s and in the early 80s. This metals to gold ratio that we've been featuring says something's wrong out there. We think it is in China. Today we got another very weak reading from China, and I don't think enough people are paying attention to what's going on in China. I know that their statistics, if you use GDP as your measure, look fine. 5% real growth sounds strong by U.S. standards. But underneath, if you look at the growth in electricity, for example, very, very weak in China. Here you can see copper. Copper has had a move, and it moved up when President Trump was threatening a 50% tariff on all of copper imports. This week, you can see it had, I think it was a 25%-ish decline, and that's because the tariffs were a little bit different than that. On raw copper, there are no tariffs now. On refined copper, there are. So a little bit of backtracking there. But what's also interesting about this chart vis-a-vis the previous chart, this metals to gold chart, is, copper's been pretty strong. It's other metals that have been dragging this index down. Here's the S&P price to gold. This we're paying a lot of attention to because some of the best strategists out there, our friends at GovCal, have been suggesting that we were going to spiral down into a 70s environment with tariffs causing inflation and so forth. The market's been weighing that risk, as you can see here. The most recent move, however, in this index has been up, and we think it will resume as we get through this uncertainty, especially the uncertainty around recession and the Fed. Here, relative to oil, we think this is a leading indicator of what will happen, and it looks nothing like it did in the 70s. Here, I always like to keep this chart in mind. I started my career really near the peak of this interest rates, and have been riding down the curve throughout my career, which was delightful. But you can see there's a downtrend, which is good up to a point. What did near 0% Treasury yields mean? It meant, in the case of COVID, are we going into a deflationary bust? And we got out of that. And maybe we have just bounced back to something more normal now that the Fed is letting markets work. We do think that the Fed is actually erring a bit in the other direction, as I mentioned before, and that will change. And with it, we do think interest rates along the entire yield curve will come down. This is a measure of risk, and as you can see, up until yesterday, the bond market, as measured by high yields relative to 10-year Treasury yields, didn't have a care in the world. Everything seemed fine. Well, this metric has jumped by a large amount today. I think it's 5 basis points, which for this metric is a large one-day move. And as you can see, in late 2007, it didn't seem like this metric was paying attention to any of the warning signals around housing out there until it did. Now, what could those uncertainties be? Well, as I mentioned before, we still have to figure Chinese and Mexican tariffs out. So that is an uncertainty. And of course, the Fed. If the Fed continues to rail against President Trump because it wants to preserve its independence, despite the fact that housing's relapsing and inflation is under control, well, that could be a problem as well. It would be the opposite problem of the one that many accused it of. I mean, it'd be the same problem, just waiting too long, as it did after COVID. And here's Bitcoin to gold. You can see that Bitcoin to gold is maintaining its uptrend. We'll see if it breaks out. I think the risk-on trade has helped it recently, and we think that will be the case. When that case will continue when it is clear that we're not going into a long-term recession, that the Fed is going to ease, and that a strong productivity-driven boom, I would say, in economic growth is underway, paving the way for midterm elections that should favor the majority now. So with that, I know a lot of puts and takes, a lot of charts, but it was a busy day for sure in the markets, a lot of fear surfacing once again, and yet the way we're interpreting this is another indication that the market is climbing a wall of worry. And we need these shudders every once in a while to keep speculation in check. And we think that's just another one of those checks. So with that, we'll see what happens in the next month, and I will look forward to our next In the Know.